for many of us, we have a significant portion of our retirement savings in our company's 401k account. And it makes a lot of sense, particularly if your company is matching some of your contributions. It makes it easier for you to hit your savings goals. And 401ks have some really powerful features that unfortunately very few people know about, but it can really enhance your overall retirement savings picture if you know about this. And so I'm going to go through three different tools, three different strategies that you can use with your 401k. One is for people that are 59 and older. The second tool is for people that are 55 and older. And then the third tool is for anybody. So let's start with the first one, which is for people over 59 and a half, and it's called in-service distributions. And this is an article from Motley Fool that talks about in-service distributions, but essentially it's just like it sounds. It's while you're still working at your employer. If you're over 59 and a half, the in-service distribution allows you to roll over some or maybe even all of your 401k money into an IRA. And if you do it right, and it's important that you follow the rules, but if you do it right, you can roll it into an IRA without paying any taxes. And so why would anybody want to do that? You can see here the biggest reason to consider an in-service distribution is you may have access to more investment offerings and lower cost offerings than what your 401k offers. Unfortunately, while it's nice to have the company match on our savings, on our contributions to our 401k, oftentimes we have fewer choices, and the choices we have in a 401k can tend to be more expensive. So by rolling that over into an IRA, we can access more tools and hopefully even lower cost tools. And think about it, if you've got $500,000 saved in your 401k, if you can save 1% a year by getting lower cost investment tools, that's $5,000 a year. So that's real money. Now, you want to be careful that you do this the right way so that you don't trigger taxes. And that's why it's important to talk to an accountant and also your HR department at your company, because not all plans allow you to do an in-service distribution. Okay, so that's for people that are almost 60 and above. What about people that are 55 to 60? And here the tool that I want you to know about is the IRS rule, the rule of 55. And for this one, I'm going to use a Charles Schwab article. And here they talk about some key points about the rule of 55. First, they say the IRS rule of 55 recognizes you might leave your current employer before you reach the age of 59 and a half. And if that happens, the IRS says, people might need some of their money in that 401k until they find another job, or maybe they're kind of retiring early because they lost their job. So that's where the rule of 55 comes in. Now, if it's in a regular 401k, you're still going to have to pay the taxes you take the money out. But what the rule of 55 allows you to do, if you comply with all of the rules and regulations with it, it allows you to avoid that 10% additional penalty. Now, again, it's not tax advice. You want to talk to an accountant, but I want this to be on your radar screen, the rule of 55. There's some things the Schwab article does a nice job of summarizing. You can only withdraw from the plan of your current employer. You can't withdraw from plans from past employers. And you must leave your job. Now, you can quit your job, or you could be laid off or fired, but you've got to be, that has to happen in calendar year that you turn 55 or later. So if you're 54, that entire calendar year, this strategy is not going to work for you. But while you're taking some of that money out, the balance has to stay in your 401k. And please remember, you're still paying ordinary income tax on a regular 401k withdrawal, just like you would if you were 59 and a half or older. But if you play by the rules, you can avoid that 10% penalty. Okay, and it goes on to say that even if you get another job later, they give an example where somebody's taking out distributions and they later decide to take a part-time job. The Schwab article says you can still keep taking distributions from your old plan as long as it was the 401k you were contributing to when you quit or left your job at age 55. And importantly, you have not rolled the balance of that into an IRA. Okay, so that's for people 55 plus. We talked about people 60 plus. And now the tip for all of us, what we can all do, is many 401ks allow you to take a loan out against your 401k balance. Now, this is money that, we're hoping we never have to use until we retire, but life happens. And if you're in that situation where life happens and a loan's available, it's nice to have that option, but I want to put on your radar screen what some of the negatives are to a 401k loan. So this is according to Bankrate. They have an article, The Risk of Taking Out a 401k Loan. And I want to highlight two of the negatives. The first risk is if you don't pay back that loan on time, you could end up, the IRS could reclassify that as a withdrawal, and you could end up paying ordinary income tax and that 10% penalty on it. Now, here's what most people really don't know that take out a loan, and they should know. And that is, if you quit your job or you get fired, you get laid off, that loan becomes due and payable in a short period of time. It depends on what the plan's rules are. But here, according to the Bankrate article, you'll have to pay it back more quickly if you lose your job. If you change jobs, quit, or get fired, you'll have to pay the loan back sooner than what the 401k documents typically let you take out a loan for 5 years. So now all of a sudden it becomes due and payable much sooner. And if it's not paid back sooner, then again it could trigger taxes and penalties. Now here's an example they give. If you have a 401k loan balance and you left your employer in January of 2024, you'll have till April 15th of 2025. Now, be careful, because this example was chosen carefully. This was taken out in the tax year of 2024. But what if that person had quit their job, they had an outstanding loan, and they had quit their job in December of 2024? Now, all of a sudden, it becomes due and payable in April of 2025, just 4.5 months later. So loans can be a powerful tool, but you want to be careful. You want to make sure that you understand both the pros and the cons so that you're prepared so you don't get hit with the taxes and the penalties. So those are three important things you can do with your 401k. If you enjoyed this, you're probably thinking about retirement and saving for retirement. And that's why I made this video here talking about what's the best time to retire and why waiting to retire at 65 might be a big mistake. Thanks for watching this video.